So this week we're going to talk about a framework called EIC. It stands for E is economy, I is industry, C is company. And it's a way to understand the external environment that we are in. And so one of the first things we're going to look at is we're going to ask the question about the economy. And the idea of the economy is we're going to ask two sub-questions. The first is, what is happening to the economy? And basically is a question, how is the company and industry that we're analyzing tied to the economy? Because the general idea should be a rising tide should rise all boats. So the question is, if the economy is rising, are the industry that we're looking at going to rise with it? Is it going to rise faster, slower, about the same? And is the company, excuse me, that we're analyzing also impacted by the economy? And what are its implications? So those are the two questions that we're going to try and assess for economic analysis. So question number one, what's happening in the economy? Question number two, how tied is the company or industry we're evaluating to the economy? So to help simplify this, because obviously there's a lot of things we can do with the economy, we are going to use Bloomberg. So I'm going to come over here to Bloomberg. I'm going to give you a couple of screens. So one of the screens we're going to look at is something called ECFC, which is economic forecasts. And here, just as Bloomberg aggregates companies by analysts to say what is the expectation for the company, Bloomberg also aggregates countries from economists to say what do we think is going to happen in the future based on economist projections. So you can change the country up here. This happens to be the United States. And first thing you're going to notice is there's a probability of recession. And right now it's at 100% because we're in one. But basically, you can see historical data, for example, GDP, and you can scroll down the list to see other types of economic data. And you also see forecasts. And this forecast is based on consensus of the economists. So for example, GDP is expected to drop by 5% right now in 2020. Okay, so as of right now, it's September. Over the course of 12 months, the forecast is for a drop of 5%. In 2021, it's expected to grow almost 4%, 3.8. 2022, 2.8. Okay, and again, you can kind of see what the components are and of CPI and other things that drive economy as well. So this is one of the first things is that, okay, right now, what I know about the economy is going forward, that basically it's going to be tough going, at least for the short term. But then medium term, 1 to 2 years out, economy is expected to rebound slightly. So what does that mean to the companies that I'm analyzing? So with that in mind, we're going to look at the second screen, ECSU, which stands for the Economic Surprise Index. So what Bloomberg does is it also aggregates not just economic data, but it aggregates all of the different types of information about the economy that is being published. And they put it into 6 buckets. So you have housing data, industrial data, labor market data, personal income data, retail market data, and surveys. So for example, consumer confidence. And the idea of the surprise index is kind of illustrated over here on the right. So this is a graph going back to the Great Recession in 2009, which Bloomberg started to look at over time. And what it tracks is two things. One, the S&P 500 index, so you can see what the index changes over time. And number two, what the surprises were, negative surprises or positive surprises of these indicators over here on the left. So Bloomberg has created an index based on these, there's like 42 factors in the index right now, and across the 6 categories. And putting them all together, they call it the Economic Surprise Index. And these are the various factors that have weight to that index. And so the general idea has been that when there are negative surprises, red, the economy shows up worse than expected. These are the expectations of the economists, that basically the market has been lower. And when we have positive surprises, the market has been higher. And so that has played in over time, the role of expectations. And so going back to rising tide, rising all boats. So when we see positive expectations, meaning doing better than we thought, then that should be fueling the market. So for example, if you think about the recent run up in stock prices, one thing you could basically make an argument for is that recently all of these indexes have come in better than expected. So we've had positive surprises across the board, across all 6 of these factors. And so that has probably been one of the reasons Bloomberg would argue that is correlated to a rise in share prices. Okay. Now, again, over here, you can see what the surprise is based on the information. So, for example, on 27 August, pending home sales came in. This was the actual number. This is a 1% better surprise than expected. And so this was the trading that happened that day on the stock market. This is before the information was released. This is after the information was released, and you can see what the impact was. So again, part of what we're trying to understand is, number one, how good is the economy going to be? But number two is, how good is it going to be against expectations? And when the market does better than expectations, generally that should have a positive impact on the companies themselves. When it does worse than expected, it should have a negative impact on the companies themselves. So we want to kind of put these two together to get a point of view of what we think is going to happen in the future with the economy. So that's going to be the first part of our E analysis. Okay. Second part of our E analysis is going to go to the company and the industry. So again, let's just do as an example, let's say we're doing Nike. Okay. So I'll type in Nike, or ticker symbol NKE, US equity. And then I'm going to go and I'm going to look at comparative data. So next I'm going to go to RV for relative valuation. And these are going to be Nike's default peers. Now for our purposes, we're going to use the analyst curated list, right? As opposed to the BIC's best fit algorithm wherever possible, right? So again, these are the ones that are selected by Bloomberg analysts. Say these are representative peers. The algorithm is the algorithm Bloomberg is selecting who it thinks is the best peers. And again, you can use other classifications. But for this assignment coming up, and just simplified, let's start and just stick with the analyst peers. Okay. So in this case, it's athleisure retail peers. So on this list, you should have average and market cap weighted average. Now, the good news is it appears that Bloomberg has fixed the market cap weighted average screen, which wasn't working last week. So we're going to be using that. And so to make sure that market cap weighted average is on our screen, we'll go to settings, global settings, once you're in the RV screen, and make sure that you have market cap weighted average checked. You can actually uncheck the average because we're not going to use that anymore, and make sure that you don't have show top section checked just to get more data in your screen. Hit close. So when you do that, your screen should look something like this. Now, again, the key is this top row is very important because that is the industry average, again, adjusted for size. So bigger companies like Nike have more weight to the size than smaller companies like Under Armour, right? But it's the industry average adjusted for size. So this is the default. What I want to look at is go to under markets, third tab over, and then they have a sub-tab called beta. So this is calculating an equity beta based on 2 years of historical data in real time. And this has both the raw beta and the adjusted beta. And in case you're curious to understand what a beta is, you can also go to BETA, see actually how they calculate a beta. But generally what they're going to do is they're going to look at, and this defaults to 2 years, but change in weekly stock price for Nike. They usually default to a weekly basis. You could do this and switch here if you wanted to do a different range, daily, monthly, etc. But this is 2 years. And then they basically put in a scatter diagram of change in share price for Nike against change in share price for the S&P 500 on the same date. Scatter diagram, draw a best fit trend line, regress it. The slope of this line is basically called the beta. Okay, so that's the raw beta. And so the beta of Nike is 1.111 with this data. And so what that means is that if the market goes up 1% the last 2 years, then Nike tends to go up 1.11%. If the market goes down 1%, then Nike tends to go down 1.11%. Nike's going up a little faster and a little bit faster than the market, down a little bit faster, up a little bit faster, changing a little bit higher in the market. Now, Bloomberg also puts in something called that they call the adjusted beta. And the adjusted beta is just a statistician's argument of a correlation coefficient. So what they do is they take 2/3 of the raw and 1/3 of one, and they just move the raw beta 1/3 closer to the mean, okay? With the idea that we're going to have distributions that look a little more standard over time. So again, that's the adjusted beta, and when Bloomberg actually uses beta, they use the adjusted. For our purposes, we're going to care about the raw. That's just a choice I'm making arbitrarily in this class. But here's the idea. So transitive property, right? The market is going to be influenced by the economy. A good economy, better market, worse economy, worse market. The next question is, how tied is a company and an industry to the market? Therefore, tied to the economy, okay? So we're going to use beta as the proxy for economic sensitivity. So generally, a beta of 1, market going up and down in the company at the same rate, basically average sensitivity to the economy. Beta greater than 1, Nike's case, going up faster, down faster than 1.11 is their beta. That means they're about 11% more sensitive to changes in the economy than the average big company represented by the S&P 500. Beta below 1 would be less sensitive. So beta is going to be our proxy, just a simple one to get started, on market sensitivity. And instead of going to the beta screen, what we're going to do is, again, go to RV. We'll have our Nike list, go to markets, and beta. And in this case, what we care about is not just the raw beta for Nike, but I also care about the raw beta for the industry. So what is the industry beta? And the industry equity beta right now is 1.16, and Nike is 1.11. So translation, the industry is about 16% more sensitive than the average company in the S&P 500 to changes in the economy. So therefore, the athleisure industry is an industry that I care much more about the economy, because as things happen in the economy, they're going to impact this industry more than the average company, although Nike is slightly less sensitive than the overall average. Now, following that logic, if I were doing Under Armour with a beta of 1.7, right now they're very economically sensitive. So if we see a big surge in the economy, then you can make an argument that now would be a really good time to buy Under Armour, okay? And if we expected a big downturn, you probably want to get out of Under Armour, okay? So that's some of just the way that we want to start thinking about this data. So as part of your assignment, I'm going to ask you to take the screenshot. So up here's the screenshot button. Take screenshot, save your file, and name it. In this case, I'll call it NKE/beta. And this is going to be one of the files that you're going to turn in for your assignment. And then for your assignment, homework 2, I'm going to ask you to basically say, how sensitive is the industry and the company based on the economic information that you looked at? So when you do your analysis, you would say, and this is very important to use numbers, that the athleisure industry that Nike competes in, if Nike was my answer in my paper, I would write that Nike's industry's beta is 1.16, therefore it is more sensitive than the average company, and Nike with a beta of 1.11 is more sensitive than the average company in the S&P 500, but slightly less sensitive to economic changes than their industry. Okay? And that's what we'd want to do for our E analysis in the EIC. Second part of the I in the EIC stands for industry. And industry is also very important. Just cover those slides in there. And we had talked about in our first lecture that industry attractiveness is defined as a positive spread. Okay, so an attractive industry has a positive spread, an unattractive industry has a negative spread. So what we need to explain is what makes the spread attractive versus unattractive as we look across industries. And to do that analysis, we're going to use Michael Porter's 5 forces to help us do industry analysis. So Michael Porter, who wrote a book in 1984 called Competitive Advantage, basically said there's 5 forces, and if you don't know this, look it up, but basically that said these 5 forces explain the industry's level of return. Okay? So that spread can be explained by these 5 forces. And the 5 forces are the power of the buyer, the power of the supplier, the substitutes, the availability of the substitutes, the barriers to entry and exit, and the intensity of the rivalry in the industry. And these 5 forces, this model, explains your spread. So for example, if the buyers have a lot of power over us, it's harder to make money, and that tends to lead to lower spreads. If our suppliers have a lot of power over us, it's harder to make money, and that leads to lower spreads. If there's a lot of rivalry in our industry, it's much harder to make money, and that tends to compress spreads, versus if we're a monopoly and we're the only game in town. It's easier to make money. If it's really hard for new entrants to come in, it tends to diminish competition. It means the players in that industry tend to make more money. If substitutes are very viable and it's easy to trade off this product for another, well, then that actually adds to the level of the competitiveness in the industry and tends to put pressure on margins. So what we need to do is explain, and this is going to be part of your homework, using these 5 forces, the spreads that we observe. So, translation. I'm going to go back and use Nike as a working example. So once you're in the RV section of Nike, now we're going to go over to custom. And we already have a saved template. So I'll just remind ourselves to look at the ROIC, return on invested capital. In this case, as of the latest filing, hit enter. And the WACC, hit enter. And again, if you haven't done this, make sure that you have the market cap weighted average, because we want that, not the industry average. Okay, because we, again, want to make sure that a small company doesn't distort the overall average. So again, in settings, global settings, make sure that market cap weighted average is checked. So that's your industry average here, top line. Okay, and again, you can save that as a template. Now this is the screen you're going to need to do the industry and the company, so take your screenshot as well. So I'll take this, Nike RV or spread, however you want to save it. Okay, so those are going to be the 2 screenshots you're going to have to turn in for your assignment. You're going to have to turn in the beta screenshot, and you're going to have to turn in the RV spread screenshot. Okay, and again, you can save this as a template, file, save as template. And again, this was 443 fall SPR. That's what I called it in a previous class. I'll just overwrite my template. Okay, back. All right, so back to this. Here's the key. This is a slightly attractive industry because it has a positive spread. Industry average is 12.6% ROIC against a cost capital of 9%. So what I need to do is explain, using the 5 forces, why this is an attractive industry. Okay? So again, back to power buyers, power suppliers, substitutes, barriers to entry and exit, rivalry, what allows this industry to have a positive spread. Now, to help you in Bloomberg to do a 5 forces analysis, because you may not know a lot about companies, 2 things. 1, BICO, if a company has it. BI is Bloomberg Intelligence. CO is on a company, Bloomberg Intelligence on a company. And basically, what Bloomberg has done is hired analysts to write research and summarize the research on companies. So this is kind of a summary that these 2 analysts have put together, kind of curated information on Nike and its industry. Okay, so again, this is a class using the real world, so it's perfectly understandable that you could actually, Nike and athleisure is a very studied industry, to use the information out there to help you answer the questions about industry attractiveness and the 5 forces. Don't plagiarize. Okay, so cite, footnote, quote, etc. if you use it, but don't plagiarize. Don't just copy and paste. That's an ethics violation in this class. But basically, you are okay to reference cite information as long as you reference it to help you answer these questions. So this is one area that you can go through. The other area that you can go through is in ELMS. I'm not in ELMS, so let me go into ELMS. In the course site, there is another industry analysis data service that can help you with the 5 forces. So just logging in, go to our class. And off here on the left menu, it's going to be under, I think it's under V. Smith. Actually, take it back. No, it's not under V. Smith. It is under, where is it? I thought it was on here. Anyways, I'll make sure the link is on there online. But basically, you can find industry analysis online, which also does a 5 forces analysis, and you can use that information. So I'll put that link in the assignment. But essentially, whether it's BICO or using the industry analysis tools, you can basically do your 5 forces analysis. And the key is to write up 2 parts of the 5 forces. Number 1, I want to explain the current spread of the company. So again, let's say I'm doing this and I'm writing this up. So why does this industry have a positive spread of 12.64 minus 9.03? Why is it about a 3.6% positive spread? All right, so back to this. I don't think that the buyers have a lot of power. Number 1, look at this list. There's not a lot of major shoe companies, a lot of athleisure companies, and so therefore, it's not a lot of rivalry. They don't tend to rival on price, and they rival on innovation and other features, and that tends to take away power away from our buyers. We don't have as many choice, tends to hurt the rivalry, and the firms tend to make more money as a result of that. I also think that the suppliers don't have a lot of power. So the supply chains, which are basically pretty vast and controlled by these companies, and they're outsourced contract manufacturers, generally are not getting premiums over the brands, and the brands are very important. In fact, that's another feature of why this is attractive industry, that the brands create barriers to entry, and the brands also make the substitutes harder to get into this business. Think about why Lululemon gets a premium on its yoga pants, right? And again, there's a power of the brand, despite the fact that there's cheaper pants out there. So again, when you look at this industry, we have to explain why we think the conditions are favorable, and you're going to write that up. The other piece of your write-up is you're going to look in the looking glass 5 years from now, and you're going to predict to me what's going to happen to the spread. But the way that you're going to predict the spread is, rather than directly predicting the spread, what you're going to do is you're going to predict the changes in the 5 forces. Because if you basically say what we just said about the 5 forces, and you say nothing changes about those 5 forces in the next 5 years, then if the industry stays about the same, then the spread should stay about the same. If the industry gets more favorable based on the changes in the forces getting more favorable, then the spread should actually improve. And if the industry gets less favorable, then the spread should go down. So the second part of your I analysis is, to some degree, and this is where the industry research can help you, but essentially when you go through this, you can look and see, hey, what are the analysts saying about this industry's future? What are they saying about the trends? And is that going to be favorable or unfavorable in the context of the 5 forces to the industry? And in a way, you're talking about whether the spreads are going to get about the same, get better, or get worse over time. And so that's what I need you to do for the I in your analysis. The final piece of this is C. C stands for, back to PowerPoint, competitive advantage. Now, the way we're defining competitive advantage, again, I'll go back here, is competitive advantage is, actually this slide, is spread relative to peers. So to have competitive advantage, you need to have better spread than your peers. So again, we'll go back to, if Nike were our company, does Nike demonstrate competitive advantage? Well, the industry spread is about 3.6%, 12.64 minus 9.03. Nike's spread is 15.2 minus 8.51. So Nike's spread is about 6.5, 6.7%. So essentially, Nike's spread is higher than the industry spread, which suggests that Nike actually does have competitive advantage. They're a great company in an above average industry. So what makes Nike better than its peers? So that goes back to the concept of competitive advantage. I need to explain that. So what about Nike is giving them an advantage? Well, one of the things that we could say that is, and again, you can use BICO to help you this, as well as the other reports like in IBIS World. But basically, one of the things that gives Nike an advantage is its brands and the innovation that it does. Matter of fact, I believe in the running shoe market, Nike's actually in a position where their runners that are using their shoes are actually winning races at a faster rate because it's actually giving them performance advantages. So technology is actually making a difference in their business. Nike is also very important with all of the the sports branding they do and the long-term commitments and deals they sign from with all these franchises. That tends to lock them in and make it hard for competitors to come in and replace their products. So there's many reasons why Nike has achieved advantage over time, but that's the point. We need to articulate why are they doing relative better than others. But that's only half the question. The final question is, again, 5 years from now, are they still going to have that level of competitive advantage? Are they still going to have that spread relative to the industry? What do you think? So again, is Nike going to maintain the advantage and maintain the spread advantage over their peers? Is it going to regress towards the mean and they're going to be about average, or are they going to increase it over time? Right? Now the data from the book suggests that over time, ROICs tend to compress towards the mean. Okay? So competitive advantages don't last forever. That's one of the information that we learn in our book. Matter of fact, growth advantages tend to slow down faster than ROC advantages, law of large number effect, right? So said a different way, competitive advantage is increasingly becoming transient, okay? And increasingly, instead of the moat castle theory, which is I build the moat around the castle to keep out the bad people, that's my advantage. Problem is, what if people don't want to invade your castle anymore? For example, technology and markets have moved on. Well, now it's become competitive advantage is considered the wave theory, which is your advantage is like a wave, it's time-based. So at some point that wave is going to crash. So you're going to ride that wave until it does, and more importantly, what's your next wave? What's your next advantage? So starting to think about it on a temporal basis, but what is Nike's advantage? What wave are they riding? How long are they going to be able to ride that wave? And are they going to be able to sustain this over time? Those are important questions to understand as we start to do our evaluation. And that's the other comment that you're going to be make in the C part of the EIC. So for your homework assignment, you are going to basically do the analysis on a company and an industry that I will give you. All right, Nike's just our working example here in class today. The first thing you'll do is you'll do an E analysis. So you will go to the screen, you'll do an RV, and again, I'm using Nike as an example. You will go to get the beta, and you'll make sure that you have market cap weighted average checked. And under markets beta, you will make an assessment about the sensitivity of the industry to the rest of the market. And so you'll be looking at this raw beta and making a determination about the sensitivity. You'll then make the company's sensitivity relative to the industry, make that determination based on the company's raw beta. And that's going to be, for simplicity for this homework, what you need to write up and show screenshots with for the E. Then for the I and the C, you're going to have to do essentially a second screenshot where you're going to go to custom, make sure you have market cap weighted average, have the spread based on ROIC for the latest filing against the WACC. Again, you'll define whether or not it's an attractive industry. You'll explain with the 5 forces why it's an attractive industry or not attractive industry, what explains that spread, and how that could change in 5 years. Will those forces change that change the attractiveness? Then you'll write up whether or not the company has a competitive advantage spread relative to the industry, what could be behind its competitive advantage, and make an assessment about whether or not that advantage will change over 5 years. Again, you can use the real world tools like BICO to help you, or BI, which is the business intelligence function of Bloomberg. You can use IBIS World off the portal. I'll make sure that the link is there to get to it because they write the 5 forces industry reports that I was referring to earlier in this video. But basically, you can use that information. Again, you can type it in, you can quote it, footnote it, just don't plagiarize it, right? You can't plagiarize in this class because you can reference somebody else's work, but you got to make sure that you show the references and you're going to put that into a paper. By the way, very important, I'm going to say 500 words. And in this class, 500 words means literally 500 words. So the first thing the TAs are going to do when they see your paper is they're going to open it and they're going to do a word count. And if it doesn't have 500 words, they're going to give you a 0 on the assignment. I don't care how many words you write. You write 499, you're going to get a 0. So minimum 500 words means minimum 500 words, and your name doesn't count. Okay? And then secondly, we're going to look at the screenshots. If you don't provide the screenshots for the data in your paper to support what you're saying, I'm not giving you credit. I don't care if you write 5,000 words. No screenshots, no data, no credit. And finally, when you write your paper, make sure you reference numbers. So when you're talking about economic sensitivity in your paper, right, make sure that when you have the screenshot that you're referring to, your answer isn't, oh yeah, this is a economically sensitive industry, slightly more than the average, because that will get you 0 credit. You must say something along the lines of, the industry raw beta is 1.16, and that is why it is more economically sensitive than the industry, than the S&P 500. So without numbers, there is no credit when you work through your papers. So final thing is, this is going to be, when you submitted, it's going to go through the Turnitin software for plagiarism. So if it looks like somebody else has written it before, it's going to flag it. And if you're using somebody else's paper, that's bad. And also, just as a word of warning, if you have copied and pasted sections and you don't reference things, it will flag that too. So again, I'm just saying this because this is a real world class. You're welcome to use the real world information. Just make sure that you don't plagiarize your other people's ideas. You can cite them, you can put those in the paper. That will be homework 2. If you have any questions, please feel free to ask the TAs. Otherwise, see you guys in the next class.